Hi everybody, Thomas here. We're going to be taking a look at Meta Platforms, generally known to most of us as Facebook. This is a company that has greatly expanded the number of apps that they make available to every user all over the world, and is actively involved in AI development, which is one of the reasons that the stock market over the last few months has been paying a lot of attention to them. Let's go ahead and dive straight in and let's see what the stock looks like, whether this is a stock that is a really interesting buying opportunity right now or one of our proverbial sucker's bets. This is a stock that over the past year has been following a pretty impressive upward trend. We can see from its bottom down here in roughly October of last year, just about a year ago, stock was a little bit above $80 per share. From that point, however, it's rallied and hit a recent peak earlier this summer up here at a little bit above $320. I'm going to go ahead and call this $325 per share. That's a really big increase of more than 4 times that low point from October of last year, which makes this a stock that has really been a really big winner for those who bought in a year ago. The question for those of us who may not have gotten in, but may be looking at the stock right now and considering the company's place in the world of artificial intelligence and cutting-edge technologies going forward, whether or not this is a stock that represents a good buying opportunity. As always, I like to try to focus my analysis of the stock's price performance on the basis of its relationship to its 200 and 20-week moving averages, looking for either what I call a bullish level 1 or bullish level 2 kind of a pattern. Now, this is a stock whose current pattern we can see has clearly been up for the past year, and that's one of the reasons that my 200-week average is starting to trend nicely upward. The stock, however, as we can see, is clearly well above it. 200-week moving average right now is at around $244 per share, while the stock is sitting a little bit above $306 per share. So there's about an $80 difference between those two levels. That's pretty extreme. That implies that the stock has really increased a lot of bullish momentum, and that should automatically call into question how sustainable that bullish momentum may be. The 20-week moving average is also following that same very bullish pattern, and right now is sitting at about $293 per share. So about $50 above the 200-week moving average. Again, pretty significant difference. That doesn't mean that the stock couldn't continue to go higher. It does mean that the sustainability of the current trend should automatically be called into question. The fact that the stock has yet to pierce this latest high at around $325 does imply that there's quite a bit of resistance at that level. Now, stock's about $306 right now. That means there's still almost $20 per share of room. Is that enough to make you decide whether or not that is a stock that is worth kind of buying opportunity that you're looking for? Well, it's a little under 10% based on the stock's current price, which may or may not be enough for you on a short-term or even a long-term basis. However, the probabilities of being able to see the stock continue the momentum that it has established over the last year are becoming increasingly small simply by virtue of the slope of the current trend over the last year, which we can see indicated by that 20-week moving average. All that said, maybe the near-term probability is not that high. Does that mean that the company's book of business, that their fundamentals don't support the stock's current price? Or could they possibly suggest, are they strong enough to suggest that the stock should be worth more than it is right now? Just because the stock has experienced a significant, even extreme upward trend does not always mean that it's outpaced the strength of those fundamentals. So let's go ahead and dive into that and see what we may be able to find. Okay, Meta is a company that has some really interesting fundamental strengths working for it. We can see over the past 9 months that the company has certainly been able to increase its free cash flow from about $19.3 billion 3 quarters ago to $24.2 billion as of the most recent report. That's also above the $17.3 billion of the last quarter. So those are strengths. There is a concern in the fact that compared to 12 months ago, free cash flow is a little bit lower. It's about from 26.5 billion, it's 24.2 billion now, so it's about a little over 2 billion less than it was a year ago. Increasing over the last two prior quarters before the most recent announcement, but still a little bit lower over the past year. On a free cash flow basis, that also translates to a modest free cash flow yield of 3.1%. That's not automatically bad, but it does give you an idea of where free cash flow is currently compared to the overall market cap of the stock, the overall size of the company. So it's a little bit modest right now, even with the increase. Their balance sheet is in an extremely good position. So we can see we have 53.4 billion, almost 53.5 billion in cash, and that is significantly higher over the last 12 months from 41.7 billion and also 37.4 billion in the most recent quarter. So we see a little bit of a pattern over the 3 quarters prior to the most recent report of a decline, but a significant increase in the last quarter. That increase was driven at least in part by a pretty significant increase in debt. We can see that debt from the last quarter increased from 9.9 billion to 18 point almost 4 billion just in the most recent quarter. That's not categorically bad, but it does imply that a lot of the cash that we're seeing on the balance sheet, a lot of that increase over the last year is attributable to the increase in borrowing. Relative to the amount of cash, however, we can see that the company certainly still has a lot of flexibility. They could pay off all of their cash right now and still have about $35 billion in cash on their books, which is still extremely healthy. They also boast a pretty impressive operating profile. If we're talking about the level of operating margins that they are operating with right now, we can see that over the past 12 months, net income as a percentage of revenues was 18.7% compared to 24.3% in the most recent quarter. That implies that we're seeing a significant and very important increase over these two periods. So that's a 6% increase just in the last quarter compared to 12 months ago. That implies operating margins are not only stable, but they're also increasing pretty significantly. That also explains the increase in cash along with the increase in long-term debt. And that also supports the notion, along with their free cash flow, their overall cash, that debt service is not going to be a problem. They have a lot of financial flexibility to be able to invest in their business, find ways to return value to their shareholders, and find other ways to continue to expand. Certainly to continue investing very heavily in the development of the metaverse and the other aspects of artificial intelligence in which they're already very actively engaged. This is a company that, like a lot of stocks, does not pay a dividend. Now, if you're following my trades in the Rebel Income System, that means that this is a stock that I'm not going to be using for my income generating trades. That doesn't automatically disqualify it as a useful investment, just means that it doesn't fit my particular system. I do want to note that compared to the overall fundamental strengths that I've just outlined, the company really doesn't represent a good value right now. And that is in part a reflection of the price movement over the past year. Despite the generally healthy fundamentals, those fundamentals have not increased at the same pace as the stock's current price. And that is why we can see that the fair value target price that I have it is almost 13% below the stock's current price at about $307. That means that it's really hard to make any kind of a value-based argument for Meta right now as a useful long-term buying opportunity. Let's go back to our charts now. With all of that in mind, if you are still interested in Meta, let's try to think about what the current chart is telling us about the potential upside in the near term compared to whatever additional risk you might be taking. Okay, as I mentioned, the stock right now is right at around $307 per share. So we have 307 right here. The stock's most recent major high point, what I like to call a pivot high, is right up here, and I'm just going to call this $325. That means there's a little bit less than $20 of near-term upside to that prior pivot high. The stock is going to have to break above that in order to maintain the current upward trend. And certainly based on the price action over the past couple of months, it's safe to say that the stock has struggled to to develop any continuing momentum to continue pushing above that point. So I expect 325 to operate as a pretty significant resistance point. That means there's roughly about $20 of upside from the stock's current price up to about where that most recent pivot high sits. What about in terms of risk? We can measure risk a couple of different ways. One of the ways that I like to pay attention to it is to think about it in terms of the stock's relationship to those major moving averages that I like to focus on, because those tend to act as pretty significant levels of support and resistance. Most immediate support for the stock should be at around the 20-week moving average, which I have right now at right around $293 per share. That's about $14 away from the stock's current price. If for whatever reason support at $293 doesn't hold, if the stock really starts to increase in bearish momentum, it breaks below the 20-week moving average, its next likely support point could very well be down at around the 200-week moving average, which I've got right now at around $244. That means that from that $293, there's about another $50 of downside if this $293 level doesn't hold. Let's talk about just the near-term upside and downside in terms of reward to risk. We have reward to risk then. We have $20 up compared to $14 of down. That means that we've got roughly about 1.5 to 1 reward to risk. Under normal circumstances for very near-term trades, the best and most professional traders will typically be looking for a reward to risk ratio in the neighborhood of at least 2 to 1. And if they can get better than that, then it's usually a better overall setup. This does not give us those levels. So with that 1.5 to 1 reward to risk level, the only thing that we can really say right now about Meta Platforms is that this stock is a sucker's bet. Thanks everybody for your time. Really appreciate it. If you like this video, please go ahead and subscribe to my channel. That way you can get a notification each time I post a new video with a new set of analysis or any new information about my Rebel income system. If you'd like to know how my put selling works, you can also check out this video here, and I'll outline all of the details of how my put selling system is designed and operates. Again, thanks for your time. Talk to you again soon.